The Warren Buffett Stock Portfolio by Mary Buffett and David Clark. Picture this, winter of 1973, and the stock market is in absolute freefall. The roaring bull market of the 60s? Dead and buried. Panic is spreading like wildfire. Investors who were popping champagne just months earlier are now stampeding toward the exits, dumping shares of America's finest companies for whatever they can get. Pure chaos. But there's this one guy who's seeing something completely different. While everyone else is running away screaming, he's calmly filling his shopping cart. Where they see disaster, he sees the opportunity of a lifetime. He actually described that moment by saying he felt like a sex-starved man in a harem. That guy was Warren Buffett, and the principles he used during that crash, and every crash since, built one of the most legendary fortunes in human history. Today we're cracking open a fascinating book that reveals how he does it. The Warren Buffett Stock Portfolio, written by Mary Buffett and David Clark. Now Mary brings something special to the table. She was married to Warren's son Peter for 12 years, giving her an insider's view into how this family actually thinks about money. Teaming up with David Clark, who spent years studying Buffett's approach, they've created more than just a list of stock picks. This is a complete blueprint for how to think about wealth. Let me be clear right up front, this isn't about getting rich overnight. It's something way more powerful. It's a philosophy that turns fear into your secret weapon and teaches you how to spot businesses so dominant, so unstoppable, that they can build wealth for generations. Here's what I'm promising you. By the time we're done, you won't just know what Warren Buffett buys. You'll understand the beautifully simple logic behind how he thinks. You'll start seeing the stock market not as this scary, unpredictable monster, but as a place overflowing with opportunity. You'll learn to tell the difference between a cheap piece of junk and a truly magnificent business that can weather any storm. This is how you transform market crashes from nightmare scenarios into the exact moments when fortunes are born. Let's dive in. To really grasp Warren Buffett's brilliance, we need to rewind to the beginning of his journey. Because here's the thing. The Warren Buffett we know today, the one who buys iconic companies like Coca-Cola and never lets go, isn't the investor he started out as. His first teacher was a genius named Benjamin Graham, often called the father of value investing. Graham's whole philosophy rested on one elegant idea. Find businesses the market is undervaluing, then buy them for less than they're actually worth. Buffett put it perfectly when he said Graham taught him to buy $1 for 50 cents. After the Great Depression, when tons of forgotten little companies were trading for absurdly cheap prices, this strategy was a money-printing machine. Buffett called these investments cigarette butts. He'd spot a discarded stock lying in the street, pick it up, and squeeze out one last free puff of profit before tossing it aside. It worked beautifully and made him and his early partners seriously wealthy. But gradually, something shifted in his thinking. He realized these cigarette butt companies, these bargain basement deals, were usually cheap for a very good reason. They were mediocre businesses. No staying power, no real edge over competitors. That one puff of profit was all you'd ever get. This is when Buffett's philosophy evolved. He started seeing the business world split into two distinct camps. In one camp, you've got the massive majority of companies. Ordinary, average, commodity-type businesses constantly fighting tooth and nail over who can charge the lowest price. In the other camp, there's this tiny, elite group. The special ones. Companies with something their competitors simply cannot duplicate. Warren called this magical quality a durable competitive advantage. Think of it like a medieval castle. Your average business is a castle sitting on flat, open ground. It's exposed, vulnerable. Anyone can attack from any direction. But a business with a durable competitive advantage? That's a castle surrounded by a deep, wide moat, crawling with alligators. It's protected. It has built-in structural advantages that keep competitors at bay and allow it to rake in fantastic profits year after year. This was the breakthrough moment in Buffett's evolution. He transformed from a bargain hunter chasing cheap cigarette butts into a collector of indestructible business castles. And this book, The Warren Buffett Stock Portfolio, is your guide to identifying these magnificent business fortresses. The authors break down a few simple but profound markers that form the bedrock of his approach. The first marker is surprisingly straightforward. Warren prefers his companies old. In a culture obsessed with innovation, disruption, and the next big thing, Buffett actively looks for the opposite. He wants predictability. As he says, predictable products equal predictable profits. He's hunting for businesses he can understand, businesses that won't get blindsided by some technological revolution in the next 10 or 20 years. Consider Coca-Cola, founded way back in 1886, or Procter & Gamble, selling soap since 1837. Or American Express, which started in 1850. These companies are basically selling the same stuff they did decades ago. This gives them an enormous economic edge. A company like Intel has to pour billions into research and development every single year, just to stay competitive. If they stop, their products become dinosaurs within a few years. Coca-Cola? They don't need to reinvent their formula, they just replace machinery when it wears out. Buffett once said about Wrigley's chewing gum, "I don't think the internet is going to change how people chew gum." That perfectly captures this principle. He's betting that 50 years from now, people will still be drinking Coke, shaving with Gillette razors, and munching Oreo cookies. That kind of predictability is your first clue that you're looking at a fortress with serious defenses. The second marker flows naturally from this predictability: a history of consistent earnings. If a company really has that protective moat, its financial track record should prove it. Buffett looks for a 10-year earnings history showing a consistent, powerful upward trend. Picture a mountain climber steadily ascending to the peak, never sliding back down to base camp. The book gives us a compelling example. Look at Procter & Gamble. From 2001 to 2011, its earnings per share climbed steadily upward, from $1.56 to nearly $4, a 155% increase without a single down year. Johnson & Johnson tells the same story. Now compare that to a commodity business like an airline. The book shows United Continental's earnings history, which looks like a wild roller coaster of profits and devastating losses. Why? Because airlines mainly compete on price. There's minimal brand loyalty. We all just want the cheapest seat. Same story with a car maker like Ford, whose earnings history is equally chaotic. These businesses lack a durable competitive advantage. They have no moat. They're those exposed castles on open ground, constantly under attack. A consistent rising earnings history isn't just some number on a page, it's proof. It's evidence that the company's moat is real, and that it's successfully defending its castle year after year. This brings us to the third, and possibly most transformative concept in the book: viewing a great stock as an equity bond. This idea is a complete game changer. Most people think of stocks as risky, unpredictable things, bouncing around constantly. And they think of bonds as safe, boring investments paying a fixed interest rate, like a 5% coupon every year. Buffett's revelation was that a company with a durable competitive advantage actually behaves more like a bond than a typical stock. Its earnings are so predictable that you can think of its stock as an equity bond. Here's how it works. The price you pay for the stock is like the bond's price. The coupon, or interest you receive, is the company's earnings per share that year. So if a company earns $8 per share, and you buy the stock for $100, your equity bond has an initial yield or coupon of 8%. But here's where the magic happens. Unlike a regular bond where the coupon stays fixed forever, the coupon on an equity bond grows. As the company's earnings climb year after year, the yield on your original investment keeps expanding. That 8% might become 9, then 11, then 15%, all based on that same initial $100 you invested. Let's make this concrete with one of Buffett's most legendary investments. In 1988, he bought a massive chunk of Coca-Cola at an average price of $5.22 per share. That year, Coke earned 36 cents per share, so his initial coupon was roughly 6.8%. That's a decent return. But Buffett knew Coke's moat was vast and deep. He knew that coupon would grow and grow. Fast forward to 2011. That same share of Coca-Cola was now earning $3.85. The coupon on his original $5.22 investment had ballooned to a mind-blowing 74%. And that doesn't even include the massive increase in the stock price itself. He saw Coca-Cola not as a flickering number on a screen, but as an incredible bond, whose payout was guaranteed to grow for decades. The final piece of the puzzle is the fourth marker, steadily growing per-share book value. Book value is essentially a company's net worth on paper, its assets minus its liabilities, divided by the number of shares. Now, Buffett himself admits that book value is a rough, often understated measure of a company's true worth, what he calls its intrinsic value. A company's real value comes from its future earning power, not just what its assets are worth right now. However, he uses the growth in book value over time as a reliable proxy for growth in underlying intrinsic value. In other words, if the company's book value is consistently climbing year after year, it's a very strong signal that the intrinsic value, the true economic worth of the business, is also increasing. It's another way of confirming that the castle isn't just being defended, it's actually expanding its territory and growing stronger. The book again uses the powerful contrast between Coca-Cola and Ford. From 1995 to 2011, Coca-Cola's book value per share grew at an incredible compounding rate of nearly 13% per year. The value of its fortress was steadily expanding. During that exact same period, Ford's book value actually declined by over 11% per year. Its foundation was literally crumbling. The story the numbers tell is absolutely clear. So these four markers, an old, predictable business, consistent rising earnings, the equity bond mindset, and growing book value, create the framework for identifying the world's greatest businesses. But identifying them is only half the equation. The other half is buying them at the right price. And this is where the book reveals the secret behind Buffett's harem comment during the 1973 crash. His strategy is to patiently wait for a temporary problem to strike a great company. That problem might be a market-wide crash, an industry-specific recession, or a one-time fixable company crisis. This is when these wonderful businesses go on sale. A perfect example is the salad oil scandal of 1963. American Express had loaned a fortune to a company using salad oil stored in giant tanks as collateral. When the company defaulted, American Express discovered the tanks were mostly filled with seawater. The scandal was catastrophic. The company took a massive loss, and its stock price got sliced in half. Wall Street panicked. But Buffett asked a different question. He asked, has this scandal damaged the underlying business? He realized people were still going to use American Express travelers' checks and charge cards. The moat was still intact. The company just had a huge, one-time solvable problem. He invested 40% of his partnership's money into the stock and made an absolute fortune as it recovered. He pulled the exact same move in 1990. Fears of a real estate disaster in California caused Wells Fargo's stock to plummet by almost 50%. The book quotes Buffett from his letter to shareholders that year. He wrote that even though he'd already bought some shares before the fall, he welcomed the decline because it allowed them to pick up many more shares at the new, panic prices. This is the core philosophy of the book. As he says, investors who expect to be ongoing buyers should adopt a similar attitude toward market fluctuations. Instead, many illogically become euphoric when stock prices rise and unhappy when they fall. He's literally telling us to flip our emotions upside down. Be fearful when others are greedy, and be greedy only when others are fearful. The book then walks us through a straightforward method to estimate whether a great business is selling at an attractive price. It's not about complicated algorithms. It's simple, forward-looking arithmetic. You start by calculating the company's historical earnings growth rate over the past 10 years. Then you project what its earnings might be 10 years into the future. if it continues growing at that same rate. Finally, you apply a conservative price-to-earnings ratio. The book suggests using the company's lowest P/E ratio from the last 10 years to estimate what the future stock price might be. With that projected future price, you can calculate your potential compounding annual rate of return from today's price. The question then becomes wonderfully simple. Is that potential return attractive to you? For example, their analysis of Coca-Cola in 2011 suggested a potential return of about 9.9% per year over the next decade. For American Express, it was nearly 14%. This isn't a crystal ball. It's a disciplined way of thinking about a long-term investment based on a company's proven, historical track record. It only works for companies with that durable competitive advantage, the ones with consistent and stable earnings. Trying to use it on a volatile commodity-type business would be, as the book warns, very dangerous to the health of your portfolio. Ultimately, the journey through the Warren Buffett stock portfolio takes you from complexity to simplicity. It strips away the noise, the confusing jargon, and the fear that paralyzes so many investors. It teaches you that building wealth isn't about timing the market perfectly or discovering the next hot tech stock. It's about finding a handful of truly exceptional businesses, understanding what makes them extraordinary, and then having the courage and patience to buy them when they're temporarily unloved, and hold them for a very, very long time. As we step back and absorb the lessons from the Warren Buffett stock portfolio, what strikes me most is how counterintuitive this whole approach is. In our hyperspeed world, we're conditioned to value quick results, disruption, and complexity. Buffett's philosophy flips all of that. It's built on patience, predictability, and beautiful simplicity. The most powerful lesson, in my view, is the fundamental identity shift this book encourages. It challenges you to stop thinking like a stock trader and start thinking like a business owner. A trader obsesses over the price, the minute-by-minute ticker movements. An owner obsesses over the business itself, its strength, profitability, long-term prospects. When you own a piece of a great business, a short-term dip in its stock price isn't a disaster. It's a sale. It's a chance to buy more of that wonderful business at a better price. That single perspective shift is the difference between a lifetime of financial anxiety and a lifetime of patient wealth creation. This mindset matters more than ever right now. We're constantly bombarded with financial news engineered to trigger emotional reactions, either euphoria or panic. The entire system is designed to make you act, to trade, to constantly churn your account. Buffett's approach is the perfect antidote. It's a system built on discipline, on tuning out the noise, and on focusing on just two things: the quality of the business and the price you pay for it. So how can you start applying these ideas to your own life, starting right now? Here are a couple of simple, practical actions. First, become a business detective. You don't need to buy anything yet. Just start observing. Pick 2 or 3 companies whose products you use and genuinely love. Maybe it's the company that makes your favorite shoes, your phone, or the drink you grab every afternoon. Go online and look up their 10-year earnings history. You can find this free on many financial websites. Just look at the graph. Is it a steady, upward climb, like stairs leading to the sky? Or is it a chaotic roller coaster? This simple exercise will start training your eye to spot the difference between a durable business and a vulnerable one. Second, reframe how you react to bad news. The next time headlines are screaming about a market crash and stocks are tanking, I want you to consciously pause. Instead of feeling that gut punch of fear most people experience, I want you to feel a spark of curiosity. Quietly ask yourself, I wonder which of the world's great fortresses are going on sale today. You don't have to take action immediately. Just changing the question you ask yourself is the first step toward completely transforming your financial destiny. We've journeyed through the mind of a master investor today, exploring the key ideas from the Warren Buffett stock portfolio. But a summary, no matter how thorough, is like looking at a map of an amazing city. The real adventure, the true understanding, comes when you walk its streets yourself. The book is packed with stories and detailed analyses of 17 different companies, each one a powerful lesson. If a single idea we discussed today lit something up inside you, I strongly encourage you to grab a copy. Reading it is more than just learning. It's adopting a completely new lens for seeing the world of business and wealth. You can find a link to the book in the description below. And finally, if this journey brought you some value today, a simple click on the like button and subscribing to Billionaire's bookshelf would mean the world to us. It helps us know we're creating something worthwhile, and make sure you won't miss our next exploration into a book that has the power to genuinely shape a life. Let's keep learning and growing together.